Okay, here we go. Really a random topic today. Accounting for the declaration and payment of a dividend. Explain the relationship between retained earnings and dividends. And account for the declaration and payment of dividends. Now, we need to go back to our mom and pop sole proprietor days and kind of draw on what we remember. Remember how we did first of all, the drawing account where the owner decided, I made some money, so I'm going to pull some money out for personal use and record as so and so drawing. And then we ended up rolling drawing up into our capital account at the end of the month. Then, if you recall, at the very end, when we did our final closing entries, we closed out all of our revenue accounts, income summary, all of our expense accounts, income summary. We ended up with a net income or net loss. We closed that out, that income summary balance out to our capital account, and away we go. Okay, now with a corporation, it's similar, but a little bit different. With a corporation, when you close out that income summary, you're going to close it out to retained earnings. Retained earnings would be, if a credit, that would be kind of the sum total of all of the revenue, or excuse me, all of the profit we have accumulated over the years. If retained earnings had a debit, that would mean we'd have some sort of accumulated loss. Okay, that's retained earnings from a corporate standpoint. Now, what in the heck are dividends? Now, if you're in personal finance, you know this. But dividends is where we'll take Microsoft. Who owns Microsoft? Lots of people, thousands of people, shareholders. Well, if Microsoft makes money, shouldn't the people that own Microsoft, all those thousands of people, be able to share in the profits? And they do. And those are called dividends. Now, a company, when they make money, when they make profit, they can either hold those retained earnings and reinvest them in the company and new products, new facilities, whatever, or they can pay them out in dividends to their owners. Again, a dividend is a distribution to the ownership of essentially profits made during the year, and they usually happen on a quarterly basis. All right? So again, trying to take what you know about mom and pop and moving it into the corporate world. Okay, so again, they either retain the retained earnings, keep it, or they distribute it to the owners. Okay, and again, it's very similar to the drawing account we had before. All right, so that's kind of an introduction to dividends. Okay, here we go. Sorry for the background noise there. So here are our various capital accounts in our chart of accounts for our capital area here. Capital stock would be where we've given a share of our company to people that invest in us. We're going public. We're letting people become part owners, capital stock. Paid in capital in excess of par, that'll come later. That's when we essentially say, at the very beginning, our shares are worth 20. And somebody wanting to get into it will pay 30. They pay beyond what the par or listed price initially of our share is. That would be paid in capital in excess. Whole nother topic in the future. Retained earnings, like I said, are the accumulated profits or losses of a company over time. Dividends, again, distributions to our ownership, our shareholders. That would have a debit balance. Dividends would, because that's a reduction of capital. It's also a temporary account, just like the drawing account was, where we would wrap it up and close it out in the end. Of course, income summary, you're familiar with that as the final closing entries that we made for the sole proprietorship. We'll use that same account, income summary, to close out things for the corporation. All right. So again, vocabulary, not yet distributed is retained earnings. I think I've hit that pretty well. And we share stuff with shareholders. That's dividends. Okay, without going into too much more detail than that. Now, the board of directors, who are those people? They're elected by the common shareholders. And they might meet like once a month. They're not in the day-to-day operations. They might meet once a month. They They might be board of directors for other companies. They might be chief executive officers or have some big position with another corporation, but they've been elected to represent the shareholders to run the business. Now, the board of directors make the 30,000 foot, the big picture views and decisions for the company. The managers, the chief executive officer, the chief financial officer, so on, they are tasked by the board of directors then to put that out in a day-to-day business operations thing. You're not going to see generally board of directors hanging around the business every day. They just kind of show up once a month and make decisions. Okay. And usually every quarter, the board of directors will say, hey, we made some money. Let's distribute something to our shareholders in the form of a dividend. Again, they make that decision, again, generally quarterly. Those dividends cannot exceed the balance of what we had in retained earnings. That's all we've accumulated. We wouldn't pay more than that. And they generally declare it on one date and pay it on another. Okay. And once they declare that, that becomes a legal liability of the company. They've declared it. They said, we're going to pay this. That's a promise to pay. And those shareholders are now depending upon that dividend coming. And so they have to record that as a liability right then because it becomes a legal responsibility of the company. Now, understand too that dividends are not expenses. Dividends, just like the drawing account, is a reduction of our capital balances. It's a debit balance or debit transaction, a reduction of capital. It's not an expense. It's an opposite of capital. It's like pulling money out for our shareholders. Okay. All righty. There we go with declaring a dividend. It's going to look like this, quite simply. 3 Greens board of directors said, hey, we're going to pay you 5 cents per share. Now, usually a dividend will be more than that. 5 cents per share. We currently have 75,000 outstanding shares. 75,000 times 5 cents, 3,750. Date of payment is January 15th. We're recording that in our books on December 15th. Memorandum number 43. Okay, let's take a look T account wise. We're debiting dividends. Again, that's a part of one of our capital accounts. By debiting, we're reducing capital, just like drawing was. We're paying money out, getting ready to do that. Dividends payable, recognizing a liability in our current liabilities section that, hey, we've got to pay out money in the next month to our shareholders. That's going to go out in individual checks. And usually there's like a special checking account just for dividends the company will have, that they just use that one checking account to send dividend checks, because there may be hundreds, if not thousands of shareholders that are getting these checks sent to them. We don't want to gum up our regular checking account with dividends checks. So here you go, date, account debited is dividends, contra capital account. Account credited is dividends payable. There's our memo, there's our debit, there's our account credited, and there's our credit. It's like we've done before. General journal, journalizing a dividends payable. Okay. Then when we go and pay that, you can probably guess what we're going to do there. Here they show, this is kind of interesting. I wasn't quite ready for this. They show the quarterly payment of dividends payable. Notice that they declare it on, in this case, the most recent one, they declared it on 12/15. They paid it on 1/15. Now, this is a little bit confusing. It says 12/15 paid. I'm not sure why it says that. All right. That would be declared on 1 month and paid the next. That might be a typo. I'm going to go check the textbook on that one. Okay. And then you see cash being paid out on 1/15. So here we have the 37.50 debit. We're reducing or eliminating, actually. We're going to dividends payable will become zero. We're going to pay our liability and credit cash. Now, they might show this in the general. No, they're going to show this in the cash payments journal, right? Cash payments journal, paying out dividends payable. There it is right there. 15th of January, check number 742. Now, they're going to write a check out of checking and deposit it probably in that dividends checking account. They're going to move money from one pot to the next. And then after they move that 3750 over into the dividends checking account, then they're going to issue another set of checks to all the shareholders for that money. All right. Very good. Date, account title, check number, debiting dividends payable, wiping out the liability, crediting cash. Under what major chart of accounts division of the owner's equity accounts for a corporation normally listed? Owner's equity. Good question. Stockholders' equity. I guess it's kind of a fancy way of saying instead of owner's equity, we're saying stockholders' equity if it's a corporation, right? Okay. Why is only one account maintained for the investment of all owners of a corporation? Another kind of weird question. We're supposed to have a chart of accounts for every, supposed to have an account for every shareholder we have out there. It'd be ridiculous. You wouldn't have enough room in your general ledger to do that. Your chart of accounts would be nonsense. Okay, you're only going to have one dividends account for all your shareholders and a separate checking account for them. Which account does a corporation use to record earnings not yet distributed? I hope you've picked up on that. That is retained earnings. How and when do net income and dividends impact permanent stockholders' equity accounts? Well, we're going to close out preferably our net income to retained earnings, and dividends are going to reduce retained earnings. Dividends, of course, is a temporary account that we're going to end up closing out at the end of the period, just like we did with the drawing account. We end up closing the drawing account to capital. In this case, we're going to close out dividends to retained earnings in the end. What action is required before a corporation can distribute income to its stockholders? Well, I hope you understood that the board of directors must legally declare that a dividend is happening. Okay. All right. So that's a little background on dividends. Now let's move to MindTap 11.3. This is going to be pretty straightforward for you, I do believe. And let's see here. That looks like this. The board of directors declared a dividend of $2 per share on December 15th. Well, that was a little embarrassing because I didn't get my assignment reset. But anyway, here we go. December transactions. I'm going to journalize on December 15th I've got a dividend of $2 per share. Capital stock issued is 6,000 shares. I mean, Microsoft declares dividends of 15, 20, 25 bucks a share. $2 is nothing. So I'm going to debit dividends. Let's spell it right here. Memorandum 112. Debit 12,000. 2 times 6. Credit dividends. Boy, I have a hard time spelling today. Dividends payable for 12,000. Again, a legal liability of the company. Pretty straightforward. Okay. Then on January 15th, we are going to, because we're going to be doing a general debit to dividends payable in our OC is needed in the check number column. It's check number 556. Okay. Whoops. Oh. General debit 12,000. And on that date, we're actually going to move that money over to our special checking account for our shareholders and call it good. Pretty simple, huh? Dividends payable. Take care. Oh, understand too, after we pay this, of course, dividends payable will be 0, right? Okay, looks good. Now you're going to do the on your own piece. Have a great day.